This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of Value Investing Podcast. So, in today's episode, I want to talk about common mistakes that a lot of value investors are making. I put together this list based on my experience and also based on the books that I have read in the past. So let's just talk about them. I hope that you guys agree on what I'm about to say. And there are about 8 different mistakes that I want to talk about in today's episode. So before I get started, let me just give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? The first mistake that a lot of investors are making is they try to time the market. I think this is a very common mistake, and it's something that we already know in our head, and we have been taught as a value investor by legendary investors like Warren Buffett, Peter Lynch, but we still try to time the market, and that's a huge mistake that I think that many people are making. And when it comes to buying a stock, I think that what we can do is to buy the stocks that we want to buy if the intrinsic value seems to be a lot higher than current market value. You don't have to predict how this price is going to move next day or next week or even next year. Forget about this all short-term price fluctuation, but focus on intrinsic value and only invest your money when you think that the intrinsic value is higher than current market value, and that provides large margin of safety. And that's what's important. But what happens is that you buy shares of stock that you're interested in, and you think that the intrinsic value is a lot higher than current market value. And next day you check the price again, and you get depressed if the price goes down further because you didn't really find the perfect timing when it comes to buying the stock. And I think that's a really huge mistake, because in the short term, the price can actually go either way. You know, it's just same as flipping the coin. It can go up or down in the next day or in the next week. But in the long term, price is going to converge to intrinsic value if you assess the intrinsic value correctly. So what matters is the long-term profit and how you can make that long-term profit and as you make more and more investment decisions. So don't get depressed even if you are not, right in terms of market direction over the next week or over the next month. Forget about market timing and try to focus on intrinsic value and having the large amount of margin of safety. That's what matters. The second mistake that I want to talk about is that a lot of people get influenced by the market. I know that we talked about the concept called Mr. Market in the past episode. But still, this is also something but you tend to get, influenced. And this is something that you cannot really control in some cases. So if you're the type of person who get influenced by the market a lot, then probably the stock market is not the area where you want to invest your money in, because you're going to check your stock price every single day and you're going to get influenced by the market, and it actually just not healthy for you. It's not just healthy for you mentally and physically. So you cannot really focus on your current job and concentrate on other tasks, and you constantly checking your price because you want to see how Mr. Market values your securities. If that's similar to your situation, my recommendation is stay away from the stock market, because you cannot really perform anything well for your life. So try not to be influenced by the market, and that's the advice that I want to give here. And on this point, I just want to talk about one more thing, because a lot of people asked me in the past how often they should check their stock price. My answer to that is it all depends. If you can actually maintain your calm even after checking the stock price every day, by all means, you can do that. But if you're the type of person who are influenced easily by the Mr. Market, you should refrain from checking your stock price very often, let's say every day. And also there are different variations into this approach, because in some cases you can actually check the stock prices of securities that you hold, but you don't necessarily go in and log into your brokerage account and check the total value of your portfolio. The reason why I mention this is because once you check how much you lose and how much you gain every single day, it actually translates into something very weird. Let me try to elaborate a little bit further. So let's say you have a large portfolio and your everyday gain and loss is more than $1,000. Then all of a sudden you kind of imagine what you could do with this $1,000. You could say that, oh, I could have gone on a vacation with this $1,000 and I could have purchased iPhone with $1,000. You start to imagine what you could do with that money, and that actually is not healthy, because that's going to actually lead to more influenced by the Mr. Market, and that's not really good. But in some cases, if you are passionate about doing investment research, you might have to go to different sites in order to do the research, and there's no other option other than checking the stock price frequently. And if that's the case, probably my recommendation is to just stay away from checking the total value of your portfolio in your brokerage account, but still checking the stock prices. Probably that's an alternative solution. And if you're 100% comfortable and you don't get influenced by the market, just feel free to do so. Go checking your stock price. But there's no really good benefit of doing that if you want to be a long-term investor. The reason why you're checking your stock price too often is because you want to time the market. You want to see if you can sell or buy securities, right? So that actually is tied to my first point, which is try not to time the market. Only sell your securities when there's a significant hype in the security and a lot of speculation in the security. Yeah, that's something that I wanted to talk. I mean, I can talk about it a little bit more, but let's move on to the topic in the interest of time. The next topic, don't try to evaluate your performance based on the short-term price movements. So this is something that I briefly mentioned. So let's say you buy a stock today and the stock price is $10. And next day, the stock price goes down to, $8, right? So 20% drop. Then you're going to actually get so frustrated and you're going to actually beating up yourself. But I think it doesn't mean anything. Just because the stock price goes down by 20% over the next 1 week or over the next 1 month since your initial purchase doesn't really tell you much. It could be purely due to random walk and random stock price movement. So what matters is how much earnings this company is going to make, how much sales is this company is going to make during the time period that you're considering, preferably more than 3 years. And that's what matters. I think stock price will converge to intrinsic value if you made the right assessment for your intrinsic value. So that was the third mistake that I think that a lot of value investors are making. Let's move on to the next item. Don't think of money in your brokerage account as real money. I also briefly mentioned this one in this episode 5 minutes ago. But if you start to imagine what you can do with the money that you have in your brokerage account, and that's real money, I know that that's real money, but if you start to do that, then you're going to get influenced by Mr. Market. And you're not going to actually see the things objectively. It's probably increase the probability of you selling the stocks in a fearful environment, and it's probably going to increase the probability of you buying the stocks when there's a lot of hype in the market. So that's exactly the opposite of what we want to do as value investors. So what I'm trying to do is that if I just put the money in my brokerage account, I don't see that as real money. I just see that as cyber money. I try to detach my emotions to the extent possible from the money that I have in my brokerage account. So that allows me to see all the things in a holistically, in an objective manner, and make the decisions in a rational manner. Because if you think of the money in your brokerage account as real money that you can spend on your vacation and on the items that you want to buy, and this is true and this is reality, but if you think that way, then you're probably gonna have hard time to detach your emotions from the money, and you're gonna probably make a huge mistake when you try to buy and sell your securities. So that's why I think that it's important for you to detach your emotions to the extent possible. Let's move on to the next item. The next item is don't follow others' advice without doing your own homework. Just use that as a starting point. Okay, so this is also good, I think, advice, because what I do normally is there's a website where you can see and follow a lot of legendary value investors. I can probably put the link in the show notes so that you guys can see this website. It's a great source and it's a great starting point. But what I want to emphasize is that once you trust someone, let's say Warren Buffett, I think he's a legendary value investor. But if you don't form your own opinion, if you don't actually do your own homework and just follow other people's advice or other people's portfolio, the problem is you never know when these people will sell their stocks, and you never know under what circumstances they purchase these securities and stocks, and that's really dangerous situation. So my recommendation is always do your own homework. I think that's quite important, because once you do your own homework, you know whether or not you purchase this security for long-term purposes or medium-term purposes, because in some cases people buy stocks, cyclical stocks, and they tend to sell when the cycle turns around or buy cycle turns around. So you need to at some point try to find out the right moment for you to get out or get in for certain securities like cyclical stocks. In other cases, you just buy and hold for the rest of your life. So depending on the purpose and depending on how you do the analysis, you might actually come to completely different conclusion. And in some cases, certain portfolio managers tend to sell their stocks for tax purposes, and that's not something you want to follow. So that's why I think that it's important for you to understand why you're purchasing certain securities, and you have to do your own homework in order to do that. So that was one item. Let's move on to the next item. The next item is don't envy just because people you think are not smarter than you are getting richer than you are. So this is interesting because you're going to actually have a lot of luck and a lot of skill sets needed in order to be successful. But in many cases, you're going to see your neighbors or colleagues getting richer than you are, and you kind of become envious of their wealth increase. This is not particularly good because this is also based on your emotions. It's not based on your rationale. So it's going to probably lead to the wrong conclusion and wrong decision-making process. So I highly recommend that you stay away from anything relating to emotions, whether it's emotions related to envy, jealousy, or anything like that, or fear, and so on. Yeah, that's what I wanted to say. And let's move on to the next one. The next one is don't get too hung up on valuation and science of valuation. A lot of people are trying to understand like all the assumptions relating to intrinsic value calculation. So you have many different approaches to when it comes to intrinsic value calculation. I actually created a couple of episodes in the past with respect to intrinsic value calculation. You can actually go with ratio approach. You can go with discounted cash flow analysis approach. You can go with, acquisition model approach. So there are a bunch of valuation models out there. But the reason why I say that don't get too hung up on valuation science is because in many cases, you're probably not 100% sure whether you should get into the position. If that's the situation, just take a pass. You don't have to invest your money. Truly good investments, in my opinion, will actually stand out without even performing any valuation. So let me just give you a metaphor. If you see someone really tall, do you really need to know exact height in order to say that that guy is tall? You don't have to know exact height in order to know someone is really tall. By the same token, you don't have to know exact intrinsic value of a specific security in order to know whether or not this security is undervalued. If the security is quite undervalued and has significant margin of safety, then you probably would be able to tell right off the bat just based on purely, price to earnings ratio or price to cash flow ratio. You might have to do a little bit of exercise to understand whether earnings and cash flows are normalized and true representative of yearly earnings and cash flow. But once you do that exercise, you don't have to actually go through DCF, discounted cash flow analysis. The discounted cash flow analysis is quite good in a sense that it actually produces the exact intrinsic value calculation, but it's also not good in a sense that you have to incorporate a lot of assumptions. For example, you have to know the growth rate of the security, and you have to know terminal value. You have to know how many months you want to forecast the cash flow growth, and you also have to know what kind of discount rate that you want to use for the specific security. So there are just so many assumptions that you have to make in order to actually derive intrinsic value from discounted cash flow analysis. I think my suggestion is that if you just want to go crazy, then try to figure out all nitty-gritty details about all these assumptions. I think you probably don't need to do that. And if you truly find something very undervalued, you probably don't even need to go through all these things. You can actually do DCF and reverse DCF, but don't go crazy on that. And don't go crazy on other valuation metrics. In the past, when I was taking finance classes before for my master's degree, what we actually did was we tried to forecast the balance sheet and income statement and cash flow statement for certain securities. I think that's just too crazy, How can you predict all items within the balance sheet and try to tie that to income statement items and cash flow items? I think it's a good exercise for students, but I just think that it's useless in a sense that possible for us to forecast every single item on the financial statements. But anyway, so my point here is that you're going to see undervalued security and you're going to immediately know whether or not it's going to be undervalued within very short period of time. You might have to do some due diligence, as I said, in terms of the quality of earnings and quality of cash flows. But after, a couple of hours of research, you should be able to determine whether this security is undervalued or overvalued relatively. And if it's quite undervalued, then you might not need to go through this extensive exercise of doing the valuation. Okay, so these are the 8 points that I wanted to discuss with you guys on today's show. I hope that you guys enjoy this show. And just before I end this episode, I just want you to know that I have this Value Investing Podcast website, and also I have another website called shareinvestmentideas.com where I post my investment ideas there. And I'll try to be a little bit more diligent in terms of posting my ideas and so on. But I highly recommend that you guys also share your ideas on that platform. And also you can actually request friend with me, and then I can answer any questions that you guys have, and feel free to give me comments. And lastly, just leave your comments and rating, reviews on whatever platform you listen to this podcast. I upload this podcast to iTunes, Android phone, various apps. So I try to actually read every single comments there on my website or on different platforms. So thank you very much for listening, and see you next time.